Hello, everyone, and welcome to episode 7 of Stella Vision, Stella Rising's weekly marketing update. I'm Marleah Clark, I'm our CMO. Thanks so much for joining us. I am thrilled today to have our Chief Digital Officer, Brandon Hegel, with us. He is going to give us an overview of what's happening in the digital and e-commerce landscape. He's going to give some great database predictions to help brands really strategize as we move into this really intense and crazy summer ahead of us. He's got panel data from our own community, Glimmer, as well as data from some of our key partners like Google. Brandon will answer questions at the end of the session if we have time, so please submit them in the side panel as we go. But also, please feel free to reach out to Brandon or to me anytime with questions about brand growth, whether e-com, Amazon, even retail as it starts to come back. As well as how consumer feelings, behaviors, and all of their patterns are changing. We look forward to continuing this conversation. Let's get started.
Well, thank you, Marleah, and thank you everyone for joining today, episode 7 of Stella Vision, today's e-commerce landscape and updated look. As Marleah had introduced, I'm Brandon Hegel, Chief Digital Officer here at Stella Rising, and let's jump in. So we thought we'd start Friday with a little humor, breaking into as we're all sheltering in place during this coronavirus pandemic. Obviously, our consumer behaviors have changed a little bit. We're having different needs now as the shelter in place continues to be prolonged. So this is a comic that I came across that I thought was pretty funny. The kids obviously needing their haircuts and telling mom they need haircuts, and guess what? That's dad. I can relate. I've got a little COVID-19 mullet starting in the back, business up front, party in the back. So, I think really we're all seeing that, this shelter in place does have an impact, and it's changing, how we used to operate and how we used to function with our regular patterns. And so looking at some of the impact in online behaviors, a lot of what's happened is because we're spending more time indoors and, social distancing and working through the self-quarantining, there's been obviously an increase in terms of what we do with our time in home. So certainly web traffic is up considerably, according to Verizon, about 20%. Consumers are certainly, consuming more media, especially video content, streaming content and on-demand and connected TV content especially, and as well as social. And a lot of people are basically using, messaging, going live with their stories more often to kind of tell friends and family how they're doing at this time, and continuing to invest more and more of their time there. As well as, as we know, people are moving into, having e-parties, through things like Zoom versus, being able to get together in person. And what we're going to talk about today is that consumers are really spending a lot more online. We're seeing a considerable uptick in terms of e-commerce purchasing behavior. There's a plethora of data that's going to be shared today to kind of validate that point, which makes sense. Again, consumers are stuck in their homes. They're trying to be safe. They don't want to go out into stores, and many stores are closed. So we're seeing an uptick in spend of, according to LBK, about 10 to 15% increase, not including grocery. But even now, we're seeing an acceleration of that through April and May, and that number is getting even higher, probably closer to 25% in some instances. We're going to talk about that a little bit further. So how has consumer behavior shifted? Well, Nielsen had put together basically a 6-tiered consumer behavior threshold, where they look to see how the COVID-19 pandemic is kind of impacting different markets. And so those 6 are proactive, health-minded buying. So we're seeing, that's the consumers that are doing preventative purchasing. Health has been a very important category in terms of where consumers are spending currently. And so, that's health and wellness products preventatively, right? So, you can think of things like vitamins, mushroom extracts, things that people feel are going to make them healthier and safer. Reactive health management, and this is, people purchasing protective gear like masks and hand sanitizers. Pantry preparation, so as we think about people stockpiling groceries and toilet paper and those types of things, really people want to make sure that they're getting what they need in terms of household essentials. Quarantine prep, and that's where you're seeing shortages in stores. People are making fewer visits to stores, and that's actually continued to accelerate, where people are visiting stores less and less as this has continued, and they're buying more and more with each visit. And that makes sense, right? We don't want to expose ourselves more than we have to. So a lot of people are stocking up on things, to the point where, you're starting to see, things like toilet paper and paper towels were and Lysol wipes were the things that had were the hardest to find initially and continue to be. And now you're starting to see that with meat processing plants and things, that some of the supply chains are challenged. So people are still, instituting a bit of a hoarding mentality for some of those necessities. Restricted living, so people making fewer shopping trips. Again, a big theme of today is talking about limited online fulfillment. So as we see, people are, not wanting to leave their homes and shop and be at risk, that they're shopping more online. And that's leading to a new normal state. As people start to return to daily routines, as states and local governments start to ease restrictions, you're going to see, a different retail environment. You're going to see people doing different things. You're going to see people wearing masks, staying 6 feet away. I'm sure everybody who's been to a store and has seen, arrows and stop signs drawn, having people go one way through a store. Or they've seen, tape on the floors, having people stay 6 feet apart. And so as the supply chain is adjusted and people return to daily routines, it's going to be a different world than it was before. A lot more contactless payment, those types of things. So one category that's really accelerated and is soaring at this time is grocery, certainly. So of all the categories, grocery and health are the two that are seeing the most significant online growth, as consumers continue to push online shopping and at-home delivery. And so, we're seeing that, shopping rates have more than doubled in the last 2 years in terms of e-grocery, with a very significant jump in 2020, which has only been accelerated through the COVID-19 pandemic. As we look at this, what's I think even more surprising is that although this has grown at a pretty significant rate, this is even with limited delivery options. So, we're seeing Instacart and other places step in and try to fill that void for that last mile delivery and recruiting a bunch of people to do shopping and delivery trips, but they can't keep up with the demand. So, even as you try to get e-delivery, you still can't do that in many instances. If we look at who's actually leading the pack, it's the biggies, Amazon and Walmart. Amazon continues to hold market share, about 62.6% in 2020. What's not quite as evident looking at this chart is that if you go down about 5 or 6 places to Whole Foods, you can see they had a pretty significant jump of about 5 percentage points. And so what that indicates is that as Amazon's Whole Food acquisition is really trickling down to the local market with Whole Foods, and that's really where the Amazon growth is coming from, is the Whole Foods growth. The 3 biggest beneficiaries in terms of growth and gains are Walmart, Target, and Costco. Big box and club, as we see that they've gained between 6 and 15 percentage points individually as they start to close the gap on Amazon. Walmart being, I think, the biggest jump. As you see, they're not that far of a laggard behind Amazon at this point. They continue to invest in their e-commerce and e-grocery and omni-channel shopping experiences. So as we shift to e-commerce, I think in the classic "a picture's worth 1,000 words," this is something that was posted by the Shopify CTO, Jean-Michel Lemieux. And I think it really shows you what's going on here, which you can see that kind of upwards trend really about mid-March, where that e-commerce growth, Shopify being primarily an e-commerce platform, you can see as we kind of went through the pre-pandemic and during pandemic timeframes, that there was a pretty significant acceleration around mid-March, and you can see that uptick growth across all their global Shopify traffic, which I think is a good indicator. Based on our friends at Google, Google Shopping has shared with us that about 60% of US consumers are shopping as much or more than they were before the pandemic. So they did a quick survey over the next 3 months, how often do you plan to shop? And you can see, most people are saying, or the largest group is about the same, but then there's a significant uptick in people shopping more. And so we did our own little survey to see, what we have a panel called Glimmer, which is our own proprietary research panel. And we went and asked women, are you shopping for products online more often now? And what we saw was that the vast majority strongly agreed or somewhat agreed. You can see about 80% agreed that they're shopping more than they were previous, prior to the pandemic. And so that's our own data that kind of validates what we're seeing. So this is interesting, and it shows that basically U.S. shoppers are spending more across almost every category in 2020 than they did last year in 2019 by retail channel. And this is offline, and you can see online is carved out specifically, and this only goes to March 15th. And you can see what's happened is that there was about a 42% increase in spend, up to this time frame year over year across the board. What that really says is consumer confidence coming into the pandemic was at a record high. Consumer purchasing was at record high levels as well. And so we had an extremely strong, consumer resiliently spending going into the pandemic. As time has gone on, some of these sectors have weakened, especially those like C-store, drug, have fallen off. But not surprisingly, club and dollar have remained strong, and e-commerce has remained strong. And home improvement has gotten extremely strong over the last couple of weeks because people are again home, and if they're going out, they're doing their gardening, they're doing their home improvements, they've got more time on their hands. So those categories are doing extremely well. And so looking at it from an e-commerce perspective, this is an aggregated panel, aggregated group of data looking across a number of different e-commerce platforms and sources, and really aggregated to get a sense for what are we seeing overall in the e-commerce landscape. And not surprisingly, medical, cleaning supplies and baby products are leading the category growth the most, which makes sense. Again, it's essentials, it's cleaning products, it's things that we need that help us feel safe. And necessity, certainly, baby products. We still need to make sure diapers and baby food and all those things, formulas, are continuing being purchased. Then the sector that kind of rounds out the middle is really CPG and entertainment. The balance of the growth. As people are looking at things that are helping, keep them entertained, keep their children educated. All those things that are going to occupy time when they're within home, as well as the staples. The consumer packaged goods that are needed, for everyday life. There's a number of data sources out there, but not surprising to see again that the declines are really led by fashion and apparel, and jewelry and luxury, automotive and travel, right? Those sectors we know are being hit as consumers are really focusing their dollars on necessities and the things that they need. And if there is discretionary spending, it tends to be on things that either help their entertainment or productivity within the home. And again, that's not surprising to see. So looking at that a different way, again, our friends at Google Shopping have shared with us what they're seeing in terms of overall search volume by week. And you can see, coming into March and April, where those diversions have happened, away from that kind of standard baseline of December, January, and February. Pretty consistent search volume levels across different categories. But as you can see, areas of that have spiked the most are fitness. People basically looking for working out at home. They can't go to the gym. They want to stay in shape. Summer is coming, regardless of how often people are going to be going to the beach. But they still want to be healthy and focus on wellness. So fitness is seeing the largest growth. Toys and games and food and groceries. Computers, again, a lot of time looking at productivity for work, entertainment, as well as education. Home and gardening now, starting to uptick as we move into spring. And consumer electronics, electronics is an interesting one. What we're seeing in the data is that large purchases are being pushed off, but a lot of smaller purchases are being made. So upgrading your mobile phone, getting new headphones or AirPods, things that are going to help you, because you're spending so much time online, either for work or entertainment. And so, again, at the bottom, the laggards, apparel and accessories, footwear, jewelry, consistent with the other data we looked at. So looking at another way to look at the data, this is pure play e-commerce. And so again, this is aggregated across a number of high growth pure play e-commerce brands, well-funded VCs, as well as Fortune 100 companies, and pretty significant businesses. And what this is really showing is that pure play e-commerce businesses kind of took a little bit of a dip in March as the pandemic was starting, as kind of people tightened their belts and kind of freaked out a little bit and said, hey, what do we need to spend? Where do we need to spend? What's going on? Let's slow down, let's pause, let's hold back. And started pulling some ad dollars out of the market. You can see the blue line being Facebook spend, the green line being Google spend. Those were reduced significantly, in the mid-March to early April periods. But then if you look at the conversion rate, it didn't quite dip as far. It did dip a little bit, and revenue dipped a little bit because there wasn't as much spend. But as people continued to test in, they realized that conversion rates were still there. There was still consumer demand. And given that a lot of these pure play e-commerce brands tend to be pretty performance based in mind, they continued to invest and see growth, return. Consumers started spending more and more online. And so we see that uptick happen, as now we're seeing we're above the mean, that baseline for the last month and a half. There was a little bit of a regression, kind of spiked and dropped, but you can see overall the trend line is pretty strong that e-commerce has continued to grow. Looking omni-channel, the trends look similar but different. You can see that conversion rate stayed higher, consistently. That revenue continued to climb, and that even though spend pulled back, similarly, again, it was that let's retrench, let's revisit, let's pause, let's stop and think. How do we want to invest? Again, the performance data and the demand was there, so little by little, those budgets and the spend started to come back. Omni-channel, I think in particular, looks differently because they closed their brick and mortar stores, but still had loyal customers, right? So a lot of those omni-channel brands and retailers, as they shut down their offline retail sales channels, they recaptured a lot of that online. So at Stella Rising, we also take a look at all of our client data. We keep regular analytics and dashboards and make sure we're monitoring what's happening across our different clients, our brands, our categories. We do tend to have a pretty heavy beauty base here within the agency, and so we monitor that pretty closely. And we're seeing a lot of strength happening, especially in the beauty sector, that overall, we saw in the last week that there was an 8% versus prior period and up 8% year ago for the same period, with Mother's Day week revenue being stronger than it was last year across both beauty and retail. So we're seeing that overall beauty continues to be pretty strong for us, especially when we look at skincare and wellness. Those areas continue to be strong. Color cosmetics not quite as strong, but we are seeing that it is improving versus what we saw earlier on in the pandemic. From a retail perspective, revenue's down a little bit. And again, it really depends on what you're looking at in the mix of retail. What sort of products are they? Apparel is softer, luxury goods are softer, things like jewelry are softer. But ultimately, we're seeing that it's the kind of more the everyday brands and things that aren't quite as exposed to the more sensitive areas are flat or rising. So even though the aggregate is down by about 22.1% from a revenue perspective, we are seeing that there is still some strength in retail sector, depending on which type of, what brand you are, what vertical you're in, what you're selling. We also look at video. Video completion rates are starting to return to prior levels, prior to social distancing. So you can see here with Facebook and Instagram videos, our video completion rate is still up about 37% over prior period. And we're continuing to see that overall, video consumption is high. But if you look at the next bullet too, click-through rate on Google and social, are still up and CPCs are down, making buying more efficient, but we're starting to see things normalize a little bit. So similar to the revenue e-commerce charts we looked at earlier, we're starting to get to a new normal period where a lot of those initial efficiencies of people pulling their ad dollars out of market, people are realizing that there is still consumer demand, there is still opportunity, there is lower buying prices, lower prices and more efficiency. And so they're coming back to market. We're starting to see things normalize. So looking at some benchmarks, these are Google benchmarks across search, display, and shopping across all industries. And so, just to get a feel for how are things performing overall. And overall, what we've seen is that, like we just talked about earlier, that click-through rates are up, CPCs are down, CPAs or cost per acquisitions are down, and daily budgets are starting to tick back up a little bit from where they were prior. Every industry is different. Certainly, if you're a travel business or a retailer, that's struggling in a certain sector, your metrics are going to be different for those categories. But in general, these are the benchmarks we're seeing. Again, looking at beauty and personal care, we can see overall that the metrics here are stronger in terms of the response that we're seeing. So click-through rates are higher across the board. CPCs are lower across the board for the average, with the exception of shopping. And CPAs are a little higher and daily budgets are a little higher. Now, the reason we see CPAs being a little higher and we see shopping being a little higher from a CPC perspective is because we're seeing a lot more competition for e-commerce across the retailers and the e-tailers. So as those brick and mortar locations have shut down, that demand is again being recaptured online. So we're seeing more competitiveness, for shopping, which tends to be very brand centric in terms of search volume. So pivoting over to some other forms of media, we've looked at what's happening in terms of invales and pricing across the overall bid stream. So the trade desk, who is a good partner of ours, takes a look at the entire bid stream. So anytime someone programmatically wants to purchase inventory, they have a view at every single transaction that's taking place and can give us a pretty good understanding of what's happening in the ecosystem. Overall, what we're seeing is a consistent trend that it tends to be more increased availability and lower costs, lower CPMs. It is starting to stabilize. Mobile video is starting to see decreases in inventory and CPMs. Mobile video in app is the opposite of mobile video standard, however, where we're seeing that there's an increase in inventory increase in inventory and CPM. And then display inventory and CPMs are starting to stabilize. So looking at that a little bit more granularly, you can see the general trend here. This is looking at period of March 1st through 15th compared to April 22nd through May 6th. And it's a pretty consistent trend that whether it's a private deal or an open deal, you're seeing that ultimately, pricing pressures are happening where it's consistently down, creating a new normal. With again, mobile and app and mobile video and app and the open exchange as well as native, both open exchange and private, being the only places where they're seeing an uptick in pricing. So that's creating a new normal and again, a more efficient pricing paradigm. So looking at that overall across all inventory and CPCs, you can see what happens is ultimately there was a divergence that started back around March 10th, where all of a sudden availability started to increase and CPM started to decrease, right? So especially those sectors that were hit hardest, luxury and travel and retail in certain sectors. As they started to pull their dollars out of the marketplace, you start to see a decrease in pricing, right, and more available inventory. In addition, when we look at connected TV and video ad, you've got all these different, you've got way more consumption happening from the consumer, like we talked about opening the presentation. So classic supply and demand, more available inventory, less advertisers in there, and that leads to a lower CPM. What's interesting is you see now here, we're seeing that convergence start to happen. So consistently with what we saw in other areas, after that initial pullback, brands are seeing that there is opportunity to be smart and to start buying. Now, I happened to just before the presentation see an updated view of this data, and this tail at the end starts to continue to diverge a little further. So the same trajectory you see, it starts to widen again and diverge a little bit further. So that's going to be something worth bearing out. But we are seeing a bit of a convergence point, which means I think we're finding a more efficient market as brands are finding the right inventory at the right pricing. So what does all this tell us? Well, I think the story is pretty clear and the data paints a pretty clear picture. People were forced to stay home during the quarantining. That shifted their media consumption and buying behaviors to online from offline. Consumer confidence and brand confidence even and everybody kind of declined a little bit from where it was prior to the pandemic. As people lost their jobs and were worried about their jobs, they started spending only on necessities. And as a result, in March, we saw conversion rate decline. We saw everything kind of retrench a little bit. But as we're seeing going through April now into May, that the consumer is resilient, right? As advertisers pulled out, pricing declined, and as advertiser demand decreased, so did their prices. But the consumer still needed their lives. They still needed to make their purchases. They still had needs. They still wanted to spend. Especially on those categories and areas we talked about. So the cost per acquisition, or the CAC, wasn't impacted as much as the price, right? Creating an efficient buying opportunity. So because the consumer is resilient and spending more online, there's advertisers coming back into the marketplace to take advantage. So this is the opportunity, right? This is, as we look at the strategic opportunity, in a recession, a lot of people panic and cut. But this is the time to actually, if you can, find the strategic way to step on the gas and invest. So there was a study done by the Harvard Business Review called Roaring Out of Recession. And what they had identified is that only 9% of companies flourish after a recession. Well, why is that? Well, the reason is because a lot of companies reduce their costs and they focus more on the operating efficiency and less so on marketing, R&D, and investing in new assets. And the truth is, really, it should be the opposite, for businesses that can do so. We're going to talk about that. But really what happens is a lot of brands when they see their businesses are pressured, they start cutting budgets in downturn, defending near-term profits, right? It becomes about the short term. How do we survive? What do we do? Let's cut everything that's not mission critical necessary. And a lot of times what will happen is brands will do so. Well, they'll cut back their advertising, they'll cut back their R&D, they'll cut back anything with new assets, and stop investing in the growth of the business to focus on what they believe to be operating necessities. And what happens is those brands ultimately that cut aggressively end up emerging weaker coming out of the downturn. And the general rule of thumb is really that it's better to maintain your share of voice at or above share of market during the downturn. The longer term improvement in profitability is much more likely to outweigh the short term reductions that are made in cutting back spend. So the growth strategies during a downturn that are typically recommended, and starting from the bottom, is you make reductions in your working capital and your admin. Where are there areas that you can pull back your spend without dramatically hurting the business? Make your cuts there. Maintain or reduce your investment in your price and your fixed assets. So don't discount more than you have to. Try to hold relative pricing, but you can still find ways, if you have margin, to give some of that back to accelerate your conversion rates. Customer preference, maintain to the overall market average. But then as we move to the top, increasing or improving relative to the market average, your new product share of sales, your marketing and your product R&D. That's where we're really seeing a lot of brands and a lot of businesses do this backwards, right? The first thing that they start cutting is their marketing and advertising and investing in their innovation and products because they feel they just need to weather the storm. But what we've seen in the data and all the studies and all the research done by a number of studies is that that's going to lead to a longer term impact on the business, and you're going to be a weaker business over time. So here it is in a chart. Looking at investing in marketing during a recession ultimately is going to pay off over the longer term. So in the pink, you can see these are the brands that did not cut their marketing spend. You can see where the recession had started, indicated by that black arrow. And ultimately, when you see in the gray bars, that's where your marketing spend was cut in years 3 and 4, which is basically in the recessionary periods. So what happened over time? Well, ultimately, the sales growth continued to accelerate for those brands that invested in the marketing, and the growth was considerably lower for those brands that had cut their marketing spend. Because again, in a recession, there's pricing efficiency, there's available inventory. You can differentiate by having an opportunity to shout your voice louder than your competition at a time when pricing is cheaper than ever. So looking at this another way, ultimately, how does cutting marketing impact profitability? So looking at firms cutting marketing, firms maintaining marketing, and firms increasing their marketing during an economic downturn. So we can see there's about a 2 percentage point delta between profitability for when you cut marketing versus when you increase your marketing. But when you look at the change in profits during the recovery, those firms that increased marketing had over a 5 percentage point delta over the firms that cut the marketing, 4.3% increase. And market share 2 years after recovery, a 1.7 percentage point increase versus only a 0.6% percentage point increase for those firms that cut their marketing. And so ultimately, the main point is that investing in a recession will pay off in most instances. So looking at the 4-year CAGR during recession recovery, or compounded annual growth rate, we can see, looking at the last 2 recessions, in the 2001 dot-com recovery, that there was about a 5 percentage point compounded annual growth rate difference over the next 4 years for those brands that had a higher investment rate in their marketing. The same thing with the 2008 recession recovery, about a 4.3% percentage point delta in terms of those that invest in their business versus did not. So our key takeaway is, obviously every business is different, everyone has different challenges, everyone has different priorities, but ultimately for those brands that can find ways to afford a continued and sustained investment through a recessionary period are going to be stronger businesses as they emerge and come through the process. So thank you very much for your time on this Friday morning. I hope that was helpful. Again, I'm Brandon Hegel, Chief Digital Officer at Stella Rising. If you have any questions, I'd be happy to take them at this time. I do see one question that came through, so let me just read that one. And then if anyone else has any questions they'd like to post, by all means, feel free. All right, so the question I have here is, do you think the uptick in e-commerce is going to continue, and for how long? So my answer to that is yes and no. I think that in the near term, consumers have no choice but to purchase a lot of things online. They don't want to leave the home, so there's a safety and a convenience in the near term, and so I think that is fueling a lot of the e-commerce growth. Retail stores are closed in many instances. It's the only way consumers can get goods. And so I think for those two reasons, yes, in the short term, clearly that's some of the main reasons why we're seeing that uptick in growth. But I think that there's going to be a bit of a bullwhip effect, right? As things kind of evolve and continue, you're going to see, pent-up consumer demand. As things start to open up and get normal, it's human nature. People want to get back to the things that they can't do the most. People can't wait to travel. They can't wait to go out and spend time with friends. They can't wait to go out to restaurants and dine again. And they certainly can't wait to go back and shop in retail stores and get back to that, especially those people that love to shop for bargains and deals and discovery. So eventually I think you're going to see, a normalization as people rush back out. It'll almost be the opposite. It'll probably be a huge, shift of people being out doing things in the physical retail world, and then it'll regress back to the normal, back to the mean. But I do think that the future state is going to permanently be changed, especially with more first-time e-commerce shoppers now buying online, especially in the boomer demographics and the older demographics. A lot of people in those demographics are purchasing online through e-commerce for the very first time, especially e-grocery. And I think they're going to continue to do so at a higher rate than prior. And I also think that a lot of the existing consumer behaviors are going to maintain at a higher rate. So if you're buying, 50% of your goods through e-commerce and stores open up, you may continue to purchase, at a higher percentage through e-commerce than you did prior. And I do think that the retail environment is going to shift as well. I think you're going to see a lot of, right before this all happened, there was a shift to the kind of zero inventory store, more of a smaller storefront to try on goods, return goods, kind of almost a customer service outpost and a kind of discovery outpost versus having inventory. And I think if you look at Nordstrom, they've done a really good job of kind of having a strong e-commerce presence, a strong, flagship presence, but also start opening a lot of these smaller outposts, for people to come in and exchange goods and kind of have that customer service aspect. I think you're going to see more and more of that in the next 12 to 18 months as kind of this new normal really starts to kind of come through. Let me see if I have any other questions here. The question, will I be sending the slide deck? Yes. We will be sending this out to everybody. Slide 11, to what date is this data updated? I will tell you what, I will respond. I'll get you the details on that. Where will mental wellness fit in behavioral categories, mindfulness, art, etc.? It's a good question. I think that will fall under the kind of health and wellness. I think we're seeing that is an area where people are focusing on growth. I think there's been a lot of people that struggle with the shelter in place and miss the socialization and things of that nature. And in one of my future presentations, I talked about, I think that there's going to be a rise of more telemedicine, especially for things like mindfulness and mental health and that sort of thing. So that's a category in an area where I think we're going to continue to see, strong growth.
Great. Thank you so much, Brandon. We are running long today, which is so great that Brandon had so much fantastic content and lots of questions. I just wanted to make sure, because I know some people are dropping off, I just wanted to definitely thank everyone for attending. And Brandon will continue. He's got more questions to answer, and I know he'll be happy to answer any of those individually. Please reach out to Brandon or to me. Stay tuned for next week's episode of Stella Vision, where our wonderful Amazon lead, Rina Yashayeva, will be back. She'll be joined by one of our fabulous clients, Rochelle Weitzner, who's CEO and founder at skincare company, The Pause Group. They are going to talk about thriving as an indie brand on e-com and Amazon. So thank you again so much for joining us. Thank you, Brandon, and we'll see you next week.
Thanks, everybody. Have a nice weekend.